The IRS just did something that tax experts said was impossible. They raised the state and local tax deduction cap to over $40,000 for 2026. If you live in a high-tax state like California, New York, or New Jersey, this one change could save you thousands of dollars. But that is just the beginning. The IRS released the complete 2026 tax provisions on October 9th, and there are 5 major changes that could dramatically reduce your tax bill. Look, I know tax season feels overwhelming. You are probably thinking, here we go again, more complicated rules, more forms, more confusion. But here is what makes 2026 different. Congress passed something called the One Big Beautiful Bill Act in July 2025, and it changed the entire tax landscape. These are not just inflation adjustments. These are real legislative changes that create massive opportunities. Most people will miss these opportunities because they do not understand how the changes work together. By the end of this video, you will know exactly which strategies apply to your situation and how to implement them before the 2026 filing deadline. And yes, everything I am sharing today is officially released by the IRS. I have spent hours reviewing Revenue Procedure 2025-32 and the actual legislation so you get accurate, verified information, not rumors or guesses. Let us start with the tax brackets because this is where the magic happens. The IRS announced the 2026 brackets with a twist. Lower brackets increased by 4%, while higher brackets only increased by 2.3%. This means if you are in that 10 or 12% bracket, you are getting extra relief. For single filers, the 10% bracket now covers $0 to $12,400. The 12% bracket goes up to $50,400. Then 22% up to $105,700. The 24% bracket covers up to $201,775. For married couples filing jointly, it is even better, $0 to $24,800 at 10%, then up to $100,800 at 12%. That 12% bracket is huge. 22% goes to $211,400. 24% covers up to $403,550. The 32% bracket is $403,550 up to $512,450. 35% goes to $768,700, and everything above that is taxed at 37%. Strategy number 1 is simple. Max out that 12% bracket before jumping to 22%. Why does this matter? Because every dollar you can keep in that 12% bracket saves you 10 cents per dollar compared to the 22% bracket. For a married couple, that is potentially over $11,000 in that sweet spot where you are only paying 12% instead of 22% or higher. Strategy number 2 is your standard deduction, and it just got better. For 2026, single filers get $16,100. Married couples filing jointly get $32,200. Head of household gets $24,150. Now here is the important part. These amounts increased by 2.2% from 2025, which already had enhanced increases from the One Big Beautiful Bill Act. So over 2 years, you are looking at substantial cumulative increases that put more money in your pocket. Now we get to the bombshell, the state and local tax deduction cap. For years, taxpayers in high-tax states have been stuck with a $10,000 cap on SALT deductions. It was brutal for families in California, New York, New Jersey, Connecticut. But the One Big Beautiful Bill Act changed everything. The SALT cap for 2026 is $40,400. Let me say that again, $40,400. Not a rumor, not speculation. This is Public Law 119-21, signed July 4, 2025. Now, before you get too excited, there are 3 critical details you need to know. Detail number 1. The exact cap for 2026 is $40,400, not $40,000. It increases by 1% each year through 2029, so 2027 will be $40,804. 2028 will be $41,212. Detail number 2. If you earn over $505,000 in modified adjusted gross income, the cap starts phasing down by 30% for every dollar over that threshold, but it never goes below $10,000. Detail number 3. This is temporary. After 2029, it reverts to a permanent $10,000 cap in 2030. But here is why this matters so much. If you are a married couple in New York City paying $20,000 in state income tax and $15,000 in property tax, you previously could only deduct $10,000. That meant $25,000 of your income was essentially taxed twice. Now you can deduct $35,000 of those taxes. At the 24% federal bracket, that saves you $6,000 per year. $6,000 every single year through 2029. That is $30,000 total if you plan correctly. Strategy number 3. Capital gains thresholds are up for 2026. If you are single and your taxable income is under $49,450, you pay 0% on long-term capital gains. 0%. For married couples filing jointly, that 0% threshold is $98,900. The 15% rate applies up to $545,500 for single filers and $613,700 for married couples. Above that, you pay 20%. But remember, the 3.8% net investment income tax still applies separately if your income exceeds $200,000 single or $250,000 married. That threshold has not changed since 2013. Strategy number 4 is huge for retirement savers. Health savings account limits are official. Individual coverage is $4,400. Family coverage is $8,750. If you are 55 or older, add another $1,000. Now, for traditional 401k and IRA limits, these are not yet official as of late October 2025, but here are the high-confidence projections. 401k employee deferrals are projected at $24,500. Age 50 plus catch-up is $8,000. Total contribution limit is $72,000. IRA contributions are projected at $7,500, up $500 for the first time in 3 years. Here is the critical new rule you must know. Starting January 1, 2026, if your wages exceed $150,000, all catch-up contributions must be made as Roth. This means after-tax contributions, not pre-tax. This rule was supposed to start in 2024 but got delayed. Final regulations came out in September 2025. If you are a high earner age 50 plus, you need to make sure your employer plan offers Roth options or you will not be able to make catch-up contributions at all. Strategy number 5. Max out your retirement accounts before year-end to take advantage of these increased limits and understand the new Roth catch-up requirement. Let me recap the 5 strategies that can save you thousands in 2026. Strategy 1. Max out your 12% tax bracket before jumping to higher brackets. Strategy 2. Take advantage of the increased standard deductions, $16,100 single, $32,200 married. Strategy 3. If you live in a high-tax state, the SALT cap is now $40,400. This is the game changer. Strategy 4. Plan your capital gains around the increased 0% thresholds, $49,450 single, $98,900 married. Strategy 5. Max out retirement contributions with the new higher limits and understand the mandatory Roth catch-up rule if you earn over $150,000. Now here is what you need to do right now. If you found this valuable, smash that subscribe button and turn on notifications. I release new tax and wealth building strategies every single week, and you do not want to miss them. Share this video with anyone you know in a high-tax state. That SALT cap increase is real, it is substantial, and most people have no idea it happened. You could literally save someone thousands of dollars by sharing this video. Thank you so much for watching. Remember, these are not just numbers on a page. These are real opportunities to keep more of your hard-earned money in your pocket and build wealth faster.
The 2026 tax year is your chance to implement these strategies and see real results. Drop a comment below and let me know which strategy you are most excited about. Are you in a high-tax state ready to take advantage of that SALT cap increase? Or are you focused on maxing out retirement contributions? I read every comment and I love hearing from you. Until next time, keep building wealth, keep learning, and I will see you in the next video.